What's up everyone, my name is Joris, welcome back to my finance channel. Last video we started part 1 of 2 talking about the Bogleheads investment philosophy and its 10 principles to build your finance journey. In this part 2 we will look at the principles 6 through 10 and look at the specific details for the European market and how to compare it to the American ideas and markets. So let's get right into it, right after you hit the like button for the YouTube algorithm. Last video we talked about the first 5 steps: developing a workable plan, starting to invest early and often, never to bear too much or too little risk, to diversify, and never try to time the market. If you have not seen the video yet, please pause this video and watch part 1 first. So today we are starting at principle number 6, using index funds whenever possible. As said in my last video, it is no real use to spend a lot of time to try and pick out individual stocks that will hopefully outperform the markets. Instead, it is way easier to just buy the whole market and earn a return that is linked to the worldwide economic growth. Index funds, either traditional mutual funds or ETFs, follow the index or a reference market. An index fund can, for example, be linked to the American stock market and will have all S&P 500 stocks under its wings. By investing in this index fund, you are indirectly buying all the S&P 500 stocks and will have a return closely related to the return of the S&P 500 index. The risk of bankruptcy is minimal. Even if there are a few companies that go fully bankrupt in the S&P 500 in this case, you won't feel it in your portfolio. All the other companies will cover up the losses. However, you are still exposed to the high volatility of the overall stock market, or the systematic risk as it is called. But in turn, you as an investor get the returns of the full market. The best way to diversify in these index funds is to find a mutual fund or an ETF that covers the worldwide market, so you can enjoy the return of the global economy, instead of just focusing on one small part, one small portion of the market. Principle number 7. Keeping costs low. This one is also pretty important because every single expense you make in your investment portfolio will eat away at your return. The lower your costs, the more of the return is saved. It is definitely advisable to look for a globally diversified fund with low costs. Even a 1% difference in running fees over time will have a huge difference in return. Most banks offer globally diversified funds, so take a look at their running costs and compare them with others. But if you want to do more work yourself, you can also look into ETFs, which stands for Exchange Tracked Funds, where the running costs are often considerably lower, but where you as an investor have to make all the investment decisions. But just keep in mind, every little percent you can save will compound in the future. It might not look like much on a yearly basis, but on 30 to 40 years it will give you a great difference. Minimize taxes. This one is very different for each individual country. In the USA, capital gains are taxed, so you're well off by investing in a 401k or Roth IRA. In Belgium, however, capital gains are not taxed. They are not taxable to individuals, and thus taxes have less consequences on your investments. Both dividend-paying funds and accumulating funds are a little taxed, but there's not really much difference between the two. Distributing funds, the one that give a dividend, are taxed on their paid out dividend, and the accumulation funds are taxed when you sell them. In Belgium, there are fans of both types of funds, and the advantages of one outweigh the other. There is no real preference there. Other types of stock market investing can be handy though, especially tax-wise. In Belgium, you can invest small amounts every year in your personal pension fund, where you will receive a tax rebate at the end of the fiscal year of 30% or 25% depending on the type you pick. Other types of fiscal investing, like long-term investing, are options as well. They are good, but there are non-fiscal alternatives that are often better. Investing in a worldwide index fund sometimes outperforms the fiscal investment options. One big thing to note is that all money we as Belgians have to invest is already taxed. It was taxed before we got paid out our paychecks. And that is why there are not many tax-friendly options for investing. Most fiscally friendly options are within companies and small businesses, where you can invest with pre-tax money and you can do a lot more with it. But that's a topic for another video. Long story short, while taxes are a huge deal in the USA when it comes down to investing as an individual, here in Belgium it's not really that important or efficient. So really look at the laws in your specific country and decide for yourself there. Principle 9. Invest with simplicity. Simplicity is the master key to financial success. When there are multiple solutions to a problem, just choose the simplest one. You don't need countless different funds in your investment portfolio. It will only cloud your overview. Instead, stick to a few well-diversified funds that cover the global markets. Most of these funds contain thousands of stocks, large companies, small companies, companies in the USA, companies in Europe, Asia, and so on. A simple portfolio has many advantages, lower costs being the main one. But going further, it simplifies analysis, the rebalancing of your portfolio, it reduces paperwork and record keeping, and it makes it easier to donate your portfolio to the next of kin when needed. The easier your portfolio is in upkeep, the less time you have to spend to manage it. So why waste time investing if you do not need to? Depending on your investment strategy and risk aversity, see Principle 1 in the previous video, you will only need 1 or 2 funds to build up your investment portfolio. That's it, that's easy. So you only need to invest in one single product every month. The last principle, principle number 10, might be the hardest, staying the course. Even if you follow all previous steps to the letter, you might run into trouble if you don't follow this last principle. If you don't follow all principles throughout the year. You now have set up a financial plan, you have started investing in the best global funds and you continue to do so, but you will never reach your goals if you don't keep at it. Or even worse, if you panic when the markets go south. During big bear markets, like in 2008 and 2020, investors panic. They sell their investments and they stop investing. Exactly at a time where you should be investing. In the long run, the most money is made during market crashes. When the market panics and prices drop far below their intrinsic value, that's when your consequent buying in the market will make sure that you are buying at greatly reduced prices. When the markets eventually regain traction, these small investments during the dip will grow exponentially. You should not panic at these moments, but you should stay put. And that's why we talked about having an easy to manage portfolio, so you don't spend too much time looking at your investments or skimming the markets, or skimming the news for economic news. The best investor is a dead investor, meaning the best investments are made by not doing anything. So don't fall for the newest best thing. Set your investment strategy in stone and follow it. If you want to do something extra, you want to buy something very special, do it with extra money, but not with your monthly investment money. Apart from the monthly buy-ins in the portfolio during your build-up phase, the only other tweaks you have to make are the yearly rebalancing of your portfolio to reallocate your stocks and bond percentages in accordance to your risk profile. But other than that, don't touch the portfolio. Setting up this investment strategy will take you a little while at the start, but the upkeep of a well-diversified portfolio is minimal. At the start, you spend 1 or 2 days to draw out everything, and once the ball starts rolling, you will only need 1 hour every year to rebalance your portfolio. That's not a lot of time, is it? There's no golden rule that says how much you have to save or how many years you will need to save and invest. Everyone is different, every plan is different, and every financial journey is unique. There are no two financial plans alike. Do take your time to draw out a very good plan for yourself and keep yourself motivated, even during bad times. Once set up, building up your portfolio will require minimal effort, but in the end, you will have built up a great portfolio and you won't have to worry about your retirement, at least not financially. The simplicity of the Bogleheads investment principles makes sure that anyone can do it. If you're a financial banker yourself, you're a baker, a doctor, a hairdresser, or a teacher, it doesn't matter. All it takes is a small learning curve and a little effort at the start, and you are started. If you then keep saving throughout the years, your nest egg for retirement will be very welcome. So if you have enjoyed this small two-part information series, please let me know in the comments below. Do you follow the Bogleheads investment philosophy, or do you have other personal rules that you are following? Feel free to share them with me down below. And don't forget to subscribe to the channel and hit the notification bell for the YouTube algorithm. I thank you very much for watching, and I hope to see you in the next video.